Toronto condo prices are just on the brink of sinking? What? No one expected this. Stay tuned to find out exactly what I mean. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you could join me here today. Now, on this reaction video, I'm not going to really talk about any of the articles that came out recently, just because in going through a lot of the market watch data from last week's episode on Thursday, there was something I noticed, and I was even kind of calling it out, saying that I was, seeing a little bit of slowdown in the 4 and 6 condo activity, specifically in like the EO8 area, which is the east side of downtown. So I dug a little bit deeper, and I kind of want to give you kind of my thought about what's happening right now. Now, keep in mind, this is not happening everywhere. There's certain pockets that are actually still really well off, kind of like if you're in the entertainment district, the King West district. Also, if you're near U of T by Yonge and Bay, those are fine. But everything else, looking at the inventory level, it's kind of on the brink of a little bit of, for lack of a better term, collapse, right? So again, not fear buying, but I will show you what I mean on this data, right? So the first chart I have here is courtesy of Edge Analytics, and this talks about the change in active listings, okay? So let's kind of look at the entire picture of the market right now, and then I'll point out the condo market. And this will kind of be a little bit of a recap of what I said in the market watch last week. So over here, you can see that there's a change in active listings, right? So as the market is slowing down, you can see that the percentage of listings that are getting added on that aren't being sold right now is increasing. Very similar to 2017. So this is a change as a percentage. So right now we've almost tripled the amount of listings left over at the end of each month, similar to 2017. And this is from the months of January to May. And you can see normally we're all the way down here, but clearly we're not. Now, the next thing I'll point out to you is because this chart here looks like it's doom and gloom, and this is the chart I used from the market watch. You can see that the total amount of active listings, like the actual nominal number, is actually below the 10-year average of about 9,000, like close to 10,000. Right now we're at like 8 or 9. So that's why I'm not overly panicked about the amount of inventory in the Toronto region, which is like freeholds plus condos. But what I am going to draw your attention to is the condo side. So you can see right here, this is a similar chart to the last one, but it's just extrapolated only the condo space, and I did it on a month-to-month basis, starting all the way from last year, or not last year, December 2018, right? So you can see we're averaging about 2,500 active 416 condo listings. So this is south of Steeles, between the 427 and by Port Credit. Sorry, not Port Credit, Port Union, right? So you can see right here, when the market was really hot in January, we didn't have much inventory. That's where we're like, okay, the condo probably is going to do really well, perform very well, because the price point is very low. And as people are going back into the city, leaving the suburbs, coming back in, the 4 and 6 condo makes a lot of sense. Then February, we got a little bit of inventory, but that was going to be absorbed. And then March, when it slowed down, and then it kind of creeped up. And then April creeped up some more and went above. And that's why I was like, okay, we got to monitor this, because the absorption rate of these active listings is not being absorbed fast enough, given the fact that even though rates are going up, a lot of people should be flocking to the more kind of budget-friendly sub 700 condo space. And now that the numbers out in May, you can see that we're above the norm of 2,500. So that's why I was like, okay, this seems a little bit weird. And I am seeing this in the condo space right now in certain pockets, right? Now, the next chart here is the same chart that I showed you for the active listings from January to May, but this is specifically for the condos now. And you can see here, this is abnormal. We're getting a lot more listings right now. So you can see that we're ending around, like I said, 3,200, give or take, which is the number down here. But when you compare this on a year-over-year basis, because mine goes up to December 2018, this one goes up to 2012, you can see that this is the most amount of active listings we've ever seen at the end of the period of January and May. That's a lot. And we're going into this kind of, recessionary period of higher interest rates and people not buying. I'm seeing a lot slower of an absorption rate of these condos, which is kind of why I'm making this video as in like a, public service announcement, like a PSA of saying, look, just watch out for what's happening, right? This is a lot of listings. And if this trend continues, I think we're going to be in a balanced market in the 4 and 6 condo, even before the houses in Toronto or even in the suburbs. And these were the numbers I was showing you in Market Watch, right? So we ended around like almost 3 months of inventory. And if it continues at this kind of pace right now that we're going at, we're probably going to be the first micro market to head into a balanced market of seeing like 4 months of inventory, which is wild, because I actually thought the condos were going to do better and outperform some of the other segments. So seeing this much inventory being absorbed is kind of strange. And I'm going to tell you a little bit more why I think that is in a little bit. But if this is the type of content you enjoy, make sure to help us spread the knowledge by smashing the like button and subscribing to the Prime Props channel, because every single week we make super awesome content like this. Sometimes reacting to articles, which is normally the norm on Tuesdays, but I found this as a very kind of intriguing, I don't know, like a real estate plot line that's happening right now. So I wanted to share it with you to let you know what's going on, right? Because this is a little bit time sensitive, because the news headlines aren't going to be catching this yet, because they're going to probably rely on more kind of lagging indicators. So I'm just putting it out there for you right now, let you know that I'm seeing quite a significant softness in the 4 and 6 condo space. So if you do want to kind of work with our team, again, because we get advanced analytics and we can see some of this stuff, because we look at the market and the data all the time, and you want to work with us for buying, selling, or investing, you can book a call with me using the link right here. It's www.chatwebzen.com. Now, this next chart that I was going to show you, also courtesy of Ben from Edge Analytics, is a comparison of how the inventory kind of has fared, in every single year and kind of on a month-to-month basis, right? Because the last few ones, we're just looking at, last, call it, 24 months or so. Then you got looking at year over year in the past decade. And this one here is kind of the last decade, but kind of the scale in which it's operating in. And you can see that the black is over here, which is the 2022. And you can see that it's climbing much faster than most of the other years that's clustered around here, right? So obviously you have these lines that are out of the norm, but you see your yellows, the blues, yellows 2019, the blues 2018. And we were under it. That's why we're like, okay, maybe the 4 and 6 condo space is going to perform better this year. But once we got to March, it kind of lapped them in terms of amount of inventory. And then as April, it increased, and now it's increasing. So when you plot trend lines on this, meaning matching kind of correlations to what other years looking for, 2022 is looking a lot more like 2017 right now, 2020 than it is in 2017. Because in 2017, when we got the foreign buyer tax, people kind of were like, peace out, I'm done with suburbs, and they went to condos, which is similar to what I was saying in the market watch, saying, hey, look, maybe the suburbs are going to slow down. There's going to be a gravitational push into the condo space because it's affordable and the city's opening back. But now that we're seeing the April and May trend line, we're like, this is starting to look like 2020. You know what happened in 2020? The pandemic, where everyone was like, peace out condos, I'm no longer in the city, I don't want to live in those shoebox in the sky. So seeing this amount of inventory is a little bit concerning for me. And again, I've been saying this, a month does not make a trend, but a trend does start with 1 month. And I pointed this out in April, and now that we're in May, this trend is accelerating. So I'll probably get a better idea of where June and July is, because I don't think people are selling their condos because they need to close something. Probably not. Maybe if you had it as an investment, you don't want to sell your other home, maybe as an example, but I don't think there's very many distressed condo sellers. It just seems like I think a lot of people are selling the market for one reason: interest rate hikes, and the yields are being crushed despite the fact that the rental yields are going up right now. So this is a lot of people who would have existing tenants. Maybe they're carrying rents from the pandemic when they were like 10, 20% lower than what they are now, and their interest rates are higher because they're on the variable. So that kind of weird Venn diagram of the mishmash in the middle, that may be a big segment of the people who are selling right now. And let me show you kind of this kind of demand curve next. So you can see in this chart over here that it kind of maps out the cash flow of what the condos were. And like I was saying, we weren't really getting anything positive or even neutral until about 2017, 2018 or so, right? I think this line's a little bit higher from what I remember, but you can see from this, 2020, maybe you had some neutral, but most of the time it was 2017, 2018, where 20% down, 80% loan to value still worked, and that made sense. But once the prices got up, it didn't make any sense anymore because you're getting awfully close, right? So you got that little bump over here because interest rates came down, right? So even before the pandemic, the rates were coming down in 2019 because they dried it up in 2018. So in the 2020 year, you can see that people are still buying these condos as long as maybe you had a strong portfolio to sustain the negative and you need it for a personal reason, or you want to diversify the type of asset you had in real estate, that's perfectly fine. But you don't have the frothy FOMO buyers that we had back in January that were just buying these things even they were minus $300-400 a month. And when the market's super hot and you're doing minus $300-400 a month, it makes total sense, because if you kind of add in the amount of principal that the tenant pays down, that makes sense. So when interest rates were 1.5% on the variable side, you were paying down 65% of your principal, right? But now when they're at 2.7, 2.8, or it's going to be over 3 at the end of July, I think, or so mid-July, then you're going to have about only 50% of that paid down. But because your rates also went up, your cash flow also comes down. You see what I mean? So right now, this is the first time in a very, 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 very long time, at least that I remember, where if you add your cash flow, plus you add your mortgage pay down from your tenants, you're still making no money. Meaning that after you pay off the interest and you service the taxes and the maintenance, the rent you collect right now isn't gonna cover all the expenses. And when you add in the mortgage pay down, it's not gonna cover that either. So when you're investing 20% into, say, a condo right now, and you're getting no cash flow, if anything negative, and then any money you would have made by having the mortgage paid down is actually just covering your cash flow negative, and you're still negative, you have zero returns. And that's the problem, because there's no returns in buying a condo at 20% down right now, unless you have a personal reason for it, right? So as an investor, if you're looking at these kind of numbers, it makes no sense for you to be buying a condo. Now, granted, this is all in the 416, but I am seeing like condos still move in, like, say, the U of T areas, like I was saying earlier, Entertainment District and King West. But those purchases aren't really geared towards like investors buying, because most people who are buying is probably for our family members, kids going to school somewhere, or just like an end user that needs to live there. And that stuff is moving, like in the sub 700,000, it's moving, but it doesn't make sense for an investor to buy it. So when investors, who I would say, I don't know, more than 50% of the people who buy condos see this number and they're not buying the condo for a personal reason, they're like, no, I'm not buying this, because this is a return-free risk, not a risk-free return. There's no return, and you're taking on the risk of the market softening some more. That's why I think there's a lot of condo demand being sucked out. So it's like a combination of all these things. And yes, rents are going up, right? And we'll see how that reflects on here. And let's say you get maybe $200 a month increased rent. If the interest rates go up some more and you have less mortgage pay down, after you adjust for mortgage being paid down, you still may be over here. And we'll find out in 2 months or so. But this is why I think there's a lot of softness in the condo market right now for this specific reason. The numbers for investors who make up most of the condo purchases just don't make sense. But now here's the crazy kicker, and I've been talking about this for like the last few years. Think about what would happen if you were a pre-con buyer. We're looking at these numbers right now at maybe like an average of $1,200 to $1,100 in Toronto. If you were buying the average pre-con in Toronto, it's $1,400. Imagine what your rents are going to look like, right, when you get possession. Assuming that rents still go up, I don't think the numbers would look even any better closer to this, right? So that's why I think there's a little bit of issue right now in terms of the yield. And unless rates come down, which I don't think they are, because the fight of inflation is getting really serious, the condo market's going to be really soft for a very long time. Like, we're probably going to get a little bit of a peak because people generally go and buy stuff like in the condo space, because it's not really seasonal, but like a lot of people do drive towards purchasing and renting in the summertime to get ready for the fall. And people are going back to work. But I think that sub segment of people who are buying are just going to be end users who want to get into the market. But the investor side, and we call it 50-50, I think the investors are out right now. And that's why there's so much supply being built up, because the investor demand has kind of dried up just looking at this number. And that's kind of why I was like, oh, I better make this video to kind of make a public service announcement. So you heard it here first, guys. I don't know if that's like a hot take or anything, but anyways, I hope this was helpful and you got some useful tips out of this in navigating the real estate market. If you are looking to kind of buy, sell, or invest, even in the condo space right now, and you're just not sure, given what I just showed you, it still makes sense for you to jump in the markets, or should you be selling right now, you can book a strategy call with me using the link right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.